What if I told you that putting $100,000 into two ETFs, VOO and SCHD, could lead to a $150,000 difference in results? Same timeline, same dollar amount, vastly different outcomes. And here's what's wild. Most investors choose based on vibes or Reddit threads. Not data, not fit, just vibes. But what you're about to see is based on cold, hard backtesting. It's a breakdown of how $100,000 grows in VOO versus SCHD, the long-term performance, the dividend difference, the crash test, and the behavioral traps most people fall into. Quick disclaimer before we go full ETF detective, this is not financial advice. Just education with extra energy and a sprinkle of sarcasm. Let's dig in. VOO is the S&P 500 in a bottle. Literally. It's not actively managed. There's no flashy fund manager pulling levers and trying to outsmart the market. VOO just copies the market and then beats most active funds doing it. But here's the nuance. It's not the market in the way your economics professor defined it. The S&P 500 has a dirty little secret. It's market cap weighted. That means the bigger a company is, the more influence it has. So when Apple makes up nearly 7% of your ETF, you're basically betting on Tim Cook getting a good night's sleep. VOO is nearly a third tech. That's massive. It's not just diversified across 500 companies. It's concentrated in momentum monsters. Apple, Microsoft, Nvidia, they're driving the returns bus. And that's exactly why VOO has crushed it over the past decade. Tech exploded. The Fed flooded the economy. Growth stocks soared like they had rocket boosters. Now sprinkle in a 0.03% expense ratio, which is basically free, and you get an ETF that's been laser optimized for long-term wealth creation. But here's the caveat. That tech exposure is a double-edged sword. When tech booms, VOO flies. When tech busts, VOO takes the hit right on the chin. So yeah, it's a growth machine, but only if you can stomach the swings. And now the big flip, what if you don't want volatility? What if you want your money to feel like a brick house instead of a kite in a hurricane? That's where SCHD steps in. SCHD is the ETF equivalent of a dependable pickup truck. It's not sexy, it's not trendy, but it's absurdly useful. It tracks the Dow Jones US Dividend 100 Index. That's not a popularity contest, it's a survival test. To make the cut, a company needs 10 plus years of dividend payments, strong financial health, cash flow, low debt, high return on equity, a growing dividend history. SCHD isn't chasing hype, it's filtering out trash. And the payoff? You get exposure to companies that aren't just paying dividends, they're increasing them. These aren't random checks. They're growing cash flows that can be reinvested to create compound returns. Its sector mix reflects that. Consumer staples, 19.4%. Energy, 18.9%. Healthcare, 14.5%. Tech, a modest 8.9%. SCHD keeps it grounded. Top holdings, Coca-Cola, Verizon, Cisco, not flashy, but stable. Companies that keep the lights on during recessions. SCHD is the ETF version of living below your means while quietly building wealth. It's not going to triple overnight. But in a world that loves financial fireworks, sometimes the best play is quiet consistency. Still, how does that strategy perform next to VOO, Hold My CAGR? Let's get surgical with compound annual growth rate, CAGR. It's the average return per year assuming reinvestment. Here's how they stack up. 5-year CAGR, VOO, 15.90%. SCHD, 12.23%. 10-year. CAGR, VOO, 12.82%. SCHD, 10.58%. Since inception, VOO, 14.25%. SCHD, 12.23%. So yes, VOO wins, but let's add context. VOO's advantage is largely because of the past 10 years being an unprecedented tech bull run. Apple became a religion. Nvidia basically became a meme factory with silicon chips. But what happens when that reverses? If inflation sticks? If growth slows? if the market gets moody. This is where behavioral psychology kicks in, because most investors don't earn the ETF's return. They buy high, sell low, panic, get greedy. And when that happens, SCHD stability can help people stay invested. That psychological edge? Underrated. If this point made you rethink how you measure risk, say hey in the comments. But now let's stress test both funds in an actual market crash. March 2020. Global lockdown, empty airports. Zoom becomes our lifeline. Markets crater. How did our contenders hold up? VOO dropped minus 33.99%, and SCHD dropped minus 33.37%. So much for defensive, right? But here's the subtle truth. During extreme crashes, diversification doesn't protect you. Correlation spikes. Everything tanks. But in milder pullbacks, rising interest rates, earnings slowdowns, mild recessions, SCHD can actually hold its ground better. That's because of where it's invested. Consumer staples don't go out of style. People still need detergent, aspirin, and fast food when markets go south. SCHD is like financial melatonin. It won't stop the crash, but it may help you sleep through it. VOO is your friend who drinks Red Bull, trades crypto at midnight, and owns 14 monitors. SCHD is the one with a Roth IRA, Costco membership, and strong opinions about lawn care. Sector-wise, VOO equals 30% tech, SCHD equals 19% consumer staples, 18% energy, only 8.9% tech. That mix matters. It's why VOO flies high in bull markets but dives harder in crashes. SCHD jogs slowly, but in a straight line. Still with me? Good, because here comes the real investment showdown. It's October 2011. You split $200,000 evenly into VOO and SCHD. You reinvest dividends, no trading, no emotion, just patience. Fast forward to 2025. VOO $635,000, SCHD $485,000. That's not pocket change. That's the price of patience with the right horse. Now let's zoom out. VOO delivered higher capital appreciation, big returns mostly driven by its top-heavy tech weighting. SCHD delivered more consistent cash flow. If you reinvested those dividends, you still came out strong, but this is the catch. You have to match the investment vehicle with the investor behind the wheel. VOO only works if you stay cool during drawdowns. SCHD works better if you want a smoother ride or plan to live off your portfolio soon. Which brings us to the real question. Ask yourself, can I stomach watching my portfolio drop 30% and do nothing? Am I 25 years old with decades ahead, or 55 looking to retire in 10? Do I want growth or cash flow? Or both? VOO is built for the marathon. It thrives on long-term conviction and delayed gratification. SCHD is built for sustainability. It offers reliable income and less whiplash, perfect for retirees or investors who hate surprises. But the secret sauce? Use both. Create a barbell portfolio. VOO on one side for growth, SCHD on the other for income. Let them balance each other out. Let compound interest and diversification be your silent financial assassins, because choosing one is fine, but combining them can be strategic. So what happens when you invest $100,000 into VOO or SCHD? VOO could turn it into a fortune, but only if you stay disciplined. SCHD could pay you along the way with less emotional turbulence, and the smartest investors don't just pick ETFs, they build systems. Systems that survive recessions, crashes, and late-night CNBC panic segments. If this deep dive helped you rethink how you build your portfolio, hit that like button so the algorithm gives us both a raise. Subscribe if you're serious about building wealth with strategy, not luck.